All right, let's jump right into this. Today we're taking Workday's latest Q2 fiscal year 2027 earnings report and treating it like a high-stakes financial investigation. We're going to piece together the clues hiding right there in the numbers, step by step. And look, I'm not going to just hand you the final investment rating right out of the gate. We are going to lay all the evidence on the table first. So put on your detective hat because this one, it's fascinating. Okay, let's dive into this. There is an absolutely massive number buried inside this report that is practically screaming for attention. Roughly $600 million. That is the annual recurring revenue, the AR, that Workday says is now coming directly from its artificial intelligence products.
And it's not just the sheer size of that number that's crazy, it's the explosive scale of the growth. Management noted that this AI AR is up more than 200% year over year. I mean, just last year, that figure was sitting somewhere in the low $100 million range. So it's spreading like wildfire. But right next to that explosive growth sits a second, much more sobering number. Workday's overall subscription revenue grew by 13.9%, which, it's not bad by any stretch, but it's definitely not 200%.
And that right there is the central contradiction we're looking at today. If Workday's AI business is truly exploding, why hasn't the entire company started growing explosively along with it? Is AI about to put the pedal to the metal for Workday, or is it just a really impressive new feature in a company whose core growth has naturally slowed down? Like I said, we're withholding our final verdict until we answer exactly that.
Clue 1. Unpacking the financials.
So we have to look at the fundamental health of Workday's core business, because as any good financial detective will tell you, the boring numbers usually hold the absolute best clues. Workday is a subscription software business, right? And they generated $2.471 billion in subscription revenue this quarter. That revenue comes from a massive, incredibly sticky enterprise customer base. We're talking over 11,500 organizations, including more than 65% of the Fortune 500. And think about it. Once a giant enterprise integrates Workday for their HR and finance, replacing it is ridiculously expensive and risky. That creates incredibly high switching costs, which basically forms a giant protective moat around that 13.9% growth rate.
And this brilliantly illustrates why a software company doesn't necessarily need 20% revenue growth to be highly profitable. Look at the non-GAAP operating margin here. It improved from 29.0% last year to 31.1% in the current Q2. That literally means Workday is pocketing more money from every single dollar of revenue that comes in. Because those margins are expanding, their actual earnings can grow a lot faster than that baseline 13% revenue growth.
But hold up. Here's where our narrative hits a bit of a speed bump. You would think better margins automatically mean more cash, right? Well, despite the improved profitability, quarterly free cash flow actually declined by about 22%, dropping from $588 million in the previous year down to $460 million in Q2. Now, to be fair, cash flow can fluctuate a lot quarter to quarter, and their 6-month picture is actually up. But it's a vital reminder for us to never, ever look at just one metric in isolation.
Speaking of metrics you shouldn't blindly trust, take a look at the headline earnings per share. Workday reported a diluted GAAP EPS of $2.57, which is up from just 84 cents a year ago. Sounds like a colossal blowout, doesn't it? But hold on a second. That $257 actually includes a massive $1.52 tax benefit tied to an internal restructuring transfer. That is corporate accounting magic at its absolute finest. If you just grab that headline EPS and extrapolate it into the future, you are going to make a huge valuation mistake.
Let's move on to clue 2, the AI growth paradox.
It is time to shift our investigation back to the most exciting part of this earnings report. How AI is actually functioning on the ground inside these giant enterprises. For Workday, AI is no longer just some slick presentation to wow investors. It's real, and customers are actually paying for it right now. Over a quarter of Workday's new annual contract value in Q2 was driven directly by AI products.
And just look at the real-world adoption happening here. We aren't just talking about a couple of pilot programs. Over 5,500 customers are actively using organic AI agents. These agents are handling 30 million candidate interactions and automatically scheduling 8 million interviews. Add to that their contract intelligence agent, which is driving 70% year-over-year growth in processed agreements. This really proves Workday's ultimate superpower. They don't have to go out and sell AI from scratch. They just upsell it to a massive, already captive audience.
Now, what's really interesting to see here is the backlog. That's the revenue Workday has under contract but just hasn't recognized yet.
The short-term, 12-month backlog is over $9 billion, and it's growing at 14.2%. But the total backlog, that's growing slower, at just 8%. What this tells us is that Workday has incredibly healthy near-term visibility. The existing engine is strong, and they definitely don't have to start from zero every single year.
And they are taking the cash generated from that healthy engine to buy back their own stock. Actually, they just executed a massive 9.8 million share repurchase program for $1.3 billion. But here is the catch for us as investors. Software companies are notorious for issuing a ton of stock-based compensation to their employees, so you have to make sure these buybacks are actually shrinking the total share count and increasing your per-share value rather than just treading water to offset all that employee dilution.
All right, clue 3, building the bull and bear cases.
So, we've gathered the evidence. Now let's weigh the two potential futures for this stock before we drop our final verdict. On one side, we have the incredibly optimistic bull case. Here, AI isn't just a tool, it becomes a completely autonomous execution engine for payroll, planning, and HR. AI monetization actually re-accelerates the total company growth, margins just keep expanding, and free cash flow compounds beautifully. But on the other side, the bear case is dangerous precisely because it doesn't even require Workday to fail. In the bear case, growth just settles into a sideways crawl around 10 to 12%. AI adoption happens, sure, but mostly just as an expected feature against intense competition from the likes of Microsoft, Salesforce, and Oracle. And that results in lower prices and a compressed market multiple.
In which case comes true matters heavily right now, specifically because of the valuation. With the stock trading around $193.57, giving Workday an approximate $47 billion market cap, it's trading at roughly 59 times trailing earnings. So this is not some cheap, distressed asset we're looking at. It creates a real valuation paradox. It can be a fundamentally great business, but simultaneously an average stock if you pay the wrong price and that growth doesn't accelerate.
And now, the final investment verdict.
Okay, we've weighed the evidence. We've separated out the headline earnings from the tax benefits, and we've weighed those exciting AI bookings against the actual overall revenue. So let's sum it up. Subscription growth is a healthy 13.9%, and non-GAAP margins are a strong 31.1%. Free cash flow, a bit volatile quarterly, but solid over a 6-month stretch. But that $600 million AI ARR, that is the ultimate wild card right now. Oh, and for any income investors out there, don't expect a payout. The dividend is exactly $0.
So, bringing it all together, our final framework based on the evidence is watch and wait. We're not saying sell because, frankly, this underlying business is incredibly strong. But we wait because the market still needs hard proof that a $600 million AI business can actually accelerate an entire $10 billion subscription engine. We are waiting for the numbers to prove that AI pushes overall growth meaningfully beyond that 13% baseline. I want to leave you with one final provocative thought. When the next Workday earnings report drops, don't just ask if they made money. Look right past the headline numbers. Ask yourself, is the current price giving investors enough upside for the risks involved? Are we actually seeing the transition from a great HR platform to an autonomous AI enterprise engine? Because ultimately, that is exactly the number you should be watching.